This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 93.1 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans, or you can talk to him right now at 407-916-5400.
Well, good morning, ladies and gentlemen, and welcome to the program Dollars and Cents. My name is Joel Garrison. For the next hour here on News Radio 93.1 WFLA, it is the program Dollars and Cents, where we help you make sense out of all of those decisions that have anything and everything to do with your dollars. So on the program today, we will have to talk about the Fed decision this past week about holding rates steady. What does that mean for you? A bit of a flip-flop by the folks at the Federal Reserve from where they were a couple of months ago to where they are now. So a dramatic shift there. We'll talk about what that means, who wins, who loses, what the underlying message is on that. And then we've been getting this question a bit in the office, so we thought we would spend some time chatting a little bit about it. And that is, some of you are asking, why is my Social Security check less this year than what it was last year? Why is my Social Security less this year than what it was last year? Well, we've got the most likely explanation on that. It has to do with your Medicare and how much you're paying for, or how much you have to pay for your Medicare Part B premium. So we'll talk about that. And then, of course, tax season. We got to throw in some tax stuff. This is an article that talks about the kinds of things that you probably want to avoid. Otherwise, they will create a red flag and increase your chances of an audit. But before we get to all of that, I've got to start with this. And this is a fascinating study coming out of a retirement savings survey that was done in 2018. And we all know the numbers, right? It's a pretty big disaster in terms of how little folks have saved just in general, let alone for retirement. The survey found that 42% had less than $10,000 saved. And that's just unbelievable. So then the survey also went on to look at the expenses and how people spend money, and it also further cross-sectioned that by the age. And so it produced some interesting results. And what's even more interesting is if you run the numbers on it and you cut some of these expenses, simply just cut them in half, you will find that you can save over $500,000, $600,000 for retirement and additional money. So pretty interesting stuff when people say, well, wait a minute, I'm living paycheck to paycheck. I've got nothing that I can put away towards savings or retirement. If you're like the 42% that have less than $10,000, that's a problem. So how do you do that? How do you start that process? I mean, part of it breaks down. The first step in trying to save more is always trying to figure out what you're actually spending money on. That's always the first step, right? If you're gonna try and cut costs so that you can save more, well, then it's incumbent upon you to figure out how much money you're spending and where, in fact, your money is going, right? Then, once you've done that part of the exercise, then you would rank these purchases by how much you value them. You may very well find, as you look at where that money is going and how you're spending it and how much you're spending on certain categories, that at the end of the day, you might not value those things that you're spending money on as much as you thought you do. So then it becomes a question of prioritizing them. So in order to save more, all right, okay, so the numbers are pretty abysmal, 42% less than $10,000 saved. How do you begin the process? Well, first, you have to look at and figure out, okay, how much money am I spending and where am I spending it? You got to go through that exercise. You got to take the time. You got to invest in yourself. Take the time to sit down and go through where's the money going, how much, and break it down into amounts and categories. In today's world, that's actually kind of easy to do if you stop and think about it, right? It's not like back in the day when I was growing up, where a lot of those purchases, particularly on those smaller items and things that you might, just quickly grab, were done using cash. And cash, you got to keep track of it. You got to hold the receipt. You got to write it down, stuff like that. Well, in today's world, more and more people do it in electronic record, right? They swipe a credit card, they swipe a debit card, or whatever the case may be. And hopefully between the two, they're swiping a debit card rather than a credit card, because the debit card, you're using immediately available cash versus the credit card where you're just putting it on the credit card with the intent of paying it all off, and you certainly should be if you're doing that, but sometimes mistakes happen, and then all of a sudden that cup of coffee you bought that you put on the credit card starts to cost a whole lot more because of how the interest rates on credit cards work. So, but in today's world, you can look at those electronic records and come up with a pretty good idea of where you're spending your money and how much you're spending, and then to go through the process of prioritizing. Do I really want to spend that much money on that? And what was interesting about the survey that was recently done is it was 1,000 adults across all age groups, and it asked the participants of the survey to look at how much money they spent on basically non-necessities. Non-necessities. So it broke it down into 6 different categories. And the survey participants were asked to respond based upon these 6 categories. So number 1, eating out and food delivery. Number 2, coffee. Golly, speaking of the days when you used to, do stuff in cash, coffee was like a quarter. I mean, it was a quarter. It was an expression, okay, or $1 maybe, okay. That and $1 will get you a cup of coffee. $1 doesn't get you no cup of coffee anyway. Although sometimes I think at like the local Wawa, they do it like $1 thing. Anyway, coffee, alcohol, ride-sharing services and taxis. Well, that certainly wasn't around 20 years ago, or 30 years ago, maybe 40 years ago. Anyway, ride-sharing services and taxis, new clothing and accessories, and then events like concerts or sports events or something like that. On average, the 1,000 people surveyed on those non-essential, those non-necessities of life, on average, folks spent over $5,300 per year annually on all of those expenses combined. The biggest non-essential spending was eating out. The average amount, $2,167 on food that they didn't prepare at home. Interestingly, the next biggest expense, which I would not have thought, was ride sharing. Obviously, that's a whole new world, right? Whereby on average, folks spent $993 a year. So some interesting numbers on that. When we get back, we're going to continue this conversation because then it gets kind of interesting on where the money's getting spent. And it may surprise you, or maybe not, which generation is spending the most on these non-necessities every year. We'll do that. We'll talk about that more when we get back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. This is Dollars and Cents. This is your host, Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA. Hello over there on the AM dial as well. We're simulcasting over there on 540 AM. On this part of the program, we're talking a little bit about a survey that was recently completed that looked at ways that people can, in fact, save more for retirement. And how it did that was it looked at how people are spending money, right? Makes sense. If you're going to start to save for retirement, if you're living paycheck to paycheck and you're looking for ways that you can save to boost your savings or just to simply start to save for retirement, how do you do it? Well, first, you got to kind of look at what you're spending money on, right? How much money, where you're spending it, and then prioritize it from there. This particular survey looked at 6 different items. It looked at alcohol. It looked at coffee. It looked at ride sharing. It looked at eating out and food delivery. It looked at new clothing. And it looked at events like concerts and sports. And it determined, based upon the survey participants, that folks on average spend over $5,300 per year, every year, on these non-necessities of life. Interestingly, men tend to spend a little bit more than women on these non-essential services. But the big spender by far of the age categories were the millennials. The people that are aged 25 to 44, that age group, and specifically actually the younger part of that age group, the 25 to 34 group, spent the most amount of money, an average of almost $6,300. So $1,000 more than even the average across the survey. If you strip out ages and sex and all that, that group, the millennials, were spending by far the largest amount of spending, over $6,300. The group with the least amount of spending, those aged 55 to 64. I guess they were either busy working or much more fixated on making sure that they weren't spending more as they were getting closer to retirement. But here's the interesting numbers, right? I mean, stop and think about that. So the largest expenditure on non-necessity items is by that group, specifically the group 25 to 34, over $6,300 per year. Run some numbers on that. And the effect on your savings and your retirement is pretty dramatic if you simply look at cutting that in half. Simply cut that in half. You're spending $6,300, you cut that in half, okay? It's $3,150. The reality is that you're still going to be able to go out and eat and go get your coffee and get your alcohol and go to your concert. But the reality is that perhaps not as much. I mean, this is what saving is all about. It's making decisions as to how you spend your money and ultimately prioritizing it. So at the end of the day, you can get out of the 42% that have less than 10% saved. I'm guessing that you really don't want to be in that group. So here's how you get out of it. You look at non-essential stuff like this survey did, and all you got to do is have it, right? Because if you have it, just based upon these numbers in the survey, if you were to take that 3,000. So you're 25 to 34, that age group, right? And you're spending over $6,300 on non-necessity items. Just cut that in half. $3,150. Fine, you're going to still continue to spend $3,150. Take the other one, $3,150, and put in your IRA. Put in your 401k, whatever the option is. There are options out there. Don't just sit there and say, "Oh, my employer doesn't have an option, so I don't know what to do." Oh, come on, really? You're calling rides from your phone. You're ordering takeout from your phone. Don't you think you can't research? Find me an IRA. I mean, come on, you can find it. It's easy. But as I'm going to digress now. But the government, all these state governments, these federal government proposals that keep rolling out new versions or want to keep rolling out new accounts that are available. I mean, there's accounts available for retirement. Okay, you literally have to be living under a rock to not be able to find how to open up an IRA. Okay, through the magic of your smartphone. Okay, you're calling rides, you're ordering food from it. Okay, pretty sure you can figure out how to open up an IRA. But anyway, I digressed on that. Okay, way too many state governments are out there and trying to get into this field of providing retirement accounts to folks that don't have one through your employer. Look, if you've got one through your employer, most likely that's the best option because usually the employer will match a little bit. So do that. If you don't have one through your employer, it's called an IRA, an individual retirement account. I mean, they're so pervasive out there. It's not that hard. You can go online and open one up probably in less than 5 minutes. Anyway, if you take that, half of that money that you're spending on all of those non-necessity items, if you take that and you put that in, and by the way, if you do an IRA, you also get a tax deduction. So then that would give you a higher refund, and then you'd have more money to spend on coffee and alcohol and concerts and all those other non-necessity things. Put that $3,150 into an IRA, okay, assuming a 7% return, which, by the way, is a little bit on the lower end of what the long-term performance numbers of the broad-based market have been, but let's say 7% just to be conservative. At the end of the day, your $3,000 per year, okay, grows to over $600,000. If you don't think an extra $600,000 is going to make a difference in retirement, you're crazy. Because it does. We've got plenty of clients who retired very successfully on $600,000 or less. The reality is that that's a lot of money. It's still a lot of money in today's world. No, okay, it's not the lifestyle that you see on all these social media influencers on YouTube and all that nonsense. By the way, that's not real. That's fake. So don't succumb to that, okay, particularly the folks in that millennial generation, 25 to 34. It's all fake out there. So don't look at that and say, ooh, that's the lifestyle that I want to live. Well, okay, there's other lifestyles that produce just as much happiness. And if you simply take a look at your expenses that you're spending on non-necessities, just cut them in half and save that money. Put that money towards your future. Put that money towards your retirement savings account. Put that money towards just a regular emergency savings account. Put that money into your 401k, and guess what? The years go by, you keep doing it on a consistent and regular basis, you're talking about over $600,000 difference in retirement. That, folks, is a pretty big number, don't you think? That's pretty big. So the next time you think or you hear somebody say, I do not have the ability to save any money whatsoever. I got nothing. I got no room. Okay? Take a moment and encourage them and encourage yourself to do this exercise. Go through how you're spending your money, where you're spending it on, how much you're spending it, and then start to prioritize. Take those non-necessity things and simply just kind of look at cutting them in half and save that half that you're not going to spend. It can make a dramatic, even that small amount, $3,000 starting at age 25, going over to 65, makes over $600,000 difference in the amount of assets when you get to retirement at age 65. It's pretty dramatic, and it certainly can be done. We're not talking about an awful lot of money. We're just talking about some very simple concepts and principles on the program this morning. When we get back, we will attempt to explain why your Social Security check went down. Not a simple concept, and certainly a frustrating concept to those that are experiencing the decline in their Social Security check. We'll talk about what that means and how that happens when we get back here on Dollars and Cents. This is Joel Garris, News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on 540 AM, News Radio 93.1 FM WFLA. This is Joel Garris of Nelson Financial Planning. Talking in this segment on the program about why your Social Security check may have gone down. We're getting some folks calling and saying, man, my Social Security check went down this year. What's the deal with that? And more often than not, that is because you may have gotten hit by the Medicare income-related monthly adjustment amount. Wow, that's a mouthful. The Medicare income-related monthly adjustment amount, the IRMAA. That is simply the additional amount that you have to pay towards your Part B under Medicare or Part D, the prescription drug program premium, if your income is above a certain level. Okay? And how they figure that out is the IRS will look at, in January, your prior year completed return, meaning that in January of 19, they actually looked at your 2017 return to determine that, not your 18 return, because you would not have traditionally filed your 18 return by January of the following year. So instead, they've got like a 2-year look back. So in January of 19, they would have been looking at your 2017 tax return. And here's the thing about these Medicare income-related monthly adjustment amounts. I said that very quickly. I'm starting to roll off the tongue there. The reality is that the income levels have actually shifted downward. So more and more people are getting caught by that. So where does it kick in? Well, it kicks in if you are an individual at incomes above $85,000. If you are a married couple, it kicks in at incomes above $170,000. If you are a dollar over those income limits of $85,000 and $170,000, your monthly premium for your Medicare Part B is going to jump from $135 a month up to over $189 per month. And there's really no way to eliminate that. You can certainly request, that the folks at Social Security to try and eliminate that. We've had a lot of folks request, and only a very small handful succeed at getting that extra monthly premium amount eliminated from their Medicare payment. And so what happens then is if your Medicare Part B payment is going up, it's got to come from somewhere. So they take it out of your Social Security, which is why then your Social Security check might very well be going down, particularly if in 2017 you tripped over these thresholds. Then at the end of the day, the Medicare premium is going up, which means that it's going to take more of your Social Security, and so consequently your Social Security check is going down. The numbers continue to ratchet up to the point where you could be paying as much as $460 per month for your Medicare Part B. Now, obviously, there you've got to have some pretty high income, but even that, winds up being a bigger jump, say, for example, at the next level. So if you're an individual making over $107,000 or a married couple making over $214,000, then your Medicare monthly premium for both of you, if you're married, it affects both Medicare premiums, so it does double up that increase. Your Medicare premium would basically be double from what it normally is. $135 is the normal amount. It doubles up to over $270 per month. So just be aware if you saw your Social Security check go down, it's most likely as a result of these Medicare income-related monthly adjustment amounts. The good news is they reevaluate that every year. So if you had an event in 2017 that for some reason pushed your income up to a much higher level, then a year from now you should get some reprieve on that. But just know that those income limitations exist out there, and they certainly can increase your Medicare premium pretty dramatically. Double it, triple it, quadruple it in some cases. And obviously that comes from somewhere, and so that typically would come from your Social Security check, thereby reducing how much you're getting from Social Security. So certainly something to be aware of, particularly if you're in that category that saw their Social Security check go down. That, in effect, is why that happened. So another headlines this past week, the Federal Reserve came out and finally said, hey, we are not going to be raising interest rates for the foreseeable future. So we went from, within the space of 3 months, we went from expect at least two interest rate increases during the course of 2019 to now expect zero, along with the fact that they are going to be taking a slower approach on unwinding all of the asset purchases that they did during the course of the quantitative easing efforts that they were doing, where they were going out into the marketplace and buying treasuries to keep interest rates low, thereby pushing the price up and driving the interest rate down. And so they accumulated a lot of treasuries during, sort of post the 2008 crisis, whereby they were doing this quantitative easing. So they wound up acquiring a lot of treasuries. Well, ultimately, they've got to unwind that. And the unwinding of that means that they basically go into the market and sell those treasuries to other folks. And at the end of the day, if you put too much into the market, then you could ultimately cause interest rates to rise. So they've been doing that every month, but what they also, so that has an effect of pushing interest rates up higher. So if now, not only have they announced that they're not going to raise interest rates, but that they're also going to slow down how much they're doing of these unwinding of these asset purchases. So what that means in English is that that would keep the interest rates further at the current level, or maybe even a little bit lower. We certainly saw this past week where the interest rate on treasuries actually went down as a result of that. So certainly some interesting dynamics out of the Fed. What does it mean to you on a personal basis? Well, there's clearly some winners and losers on that, and I guess the way to differentiate that is if you are a saver or a borrower, right? I mean, if you are a saver, you are finally getting some breathing room in terms of how much you might earn with money just sitting in not really much of a checking and savings account, because usually you're not seeing those rates change, but putting money in, say, a money market account. Okay, you should be able to find money market account out there today with the most recent interest rate increases that happened during the course of last year, probably paying around 2%, which, 2% is not great, but it's certainly better than 0%, which many were paying, or close to zero, which many were paying, and certainly most checking and savings accounts are paying that. So if you're a saver, got sitting on a bunch of cash, the problem with them saying, hey, we're not going to raise interest rates is that means that, well, you're going to be stuck with, your 1 to 2% in terms of how much money you're going to make on your savings. So that's probably the group that loses, I guess, the most when you basically are holding interest rates steady. We'll talk about who wins and who is in the undecided camp when we get back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio 93.1 WFLA.
This is Bud Hedinger. You can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back, ladies and gentlemen, to the program Dollars and Cents. This is Joel Garris of Nelson Financial Planning. In this segment of the program, we're talking a little bit more about the Federal Reserve. This past week, they decided to hold interest rates steady, and what on earth does that mean for you? Well, clearly, there are some winners and losers in it. Probably the biggest losers are the savers out there, particularly those that like to sit on a lot of cash. It was getting a little bit better as long as you weren't sticking money in a checking account or a low-yield savings account. You were probably getting rates certainly above 1, maybe even close to 2 on some money market accounts out there, maybe even above 2, not much above 2. But that was directly correlated to the raising of interest rates. Now, with the Federal Reserve coming out and saying, hey, we're going to hold off on rate increases this year, and we're also going to slow down our unwinding efforts, which have a tendency to push interest rates up, then at the end of the day, that means that you are not going to see much improvement in those savings rates. So that's probably the biggest category of folks that lose, if you will, when the Federal Reserve says, hey, we're going to, hold the line, if you will. Who wins? Borrowers win. And I guess that's probably not good because you don't necessarily want to encourage people to keep borrowing more and more money. But certainly from those that are looking to buy houses, that are looking to get a mortgage, having a hold on those interest rates helps to make sure that the mortgage rates will not go up. And if anything, mortgage rates certainly follow typically the Treasury yield. And so when the Treasury yield kind of shifts downward, then that also helps the trend in mortgage rates. So that means that maybe your mortgage rates will start to get more closer back down to the 4% versus the 4.5% where they've been kind of sort of hovering now. Of course, for a historical perspective, a 4.5% rate on a 30-year fixed rate mortgage is fantastic, but certainly a little bit more than what it was a couple of years ago. But historically speaking, 4.5% interest rate on a 30-year fixed rate mortgage is a pretty good rate. Rates really have been low for a very, very long period of time. But with the Federal Reserve saying, hey, we're not going to raise interest rates, then that means that for folks that are out there with trying to get a house and getting a mortgage now, their interest rate will not continue to kind of creep up, and it may very well at least hold steady, maybe slide down a little bit. Probably not get back to the 4% level, but maybe hover around on the 4.5%. So that's good news if you're in the home buying market, because that means you don't have to rush to try and get the mortgage. You can sort of take your time because it appears that those mortgage rates will be relatively stable during the course of this year, particularly with the Federal Reserve taking the position that it did this past week. For those of you that have debt on credit cards, well, number one, you need to stop that and get rid of it. But because usually any type of interest rate hike by the Fed goes immediately to the rate that credit card companies charge. Average rate that a credit card charges in America today is about 18%. So, I think you could probably borrow from the mob at a better rate. But hey, go Visa, go MasterCard. They're legitimate mobsters, I guess. But at 18%, that's pretty pricey. So, interestingly, based upon the amount of credit card debt, if you increase by just 0.25%, then it costs credit card users approximately $1.6 billion in extra finance charges for every quarter point increase. So as the Fed was kind of pushing up interest rates by a quarter point during the course of the year, and they've done that 9 times since they've started, kind of shifting rates back up. So they've certainly done a number of them over the course of the past 3 years. Every quarter point rate increase translates to an extra $1.6 billion in extra finance charges based upon the amount of credit card debt that's outstanding. That's pretty dramatic. So at the end of the day, the fact that they're holding rates steady is good if you are a borrower. Also good for folks in college, borrowing student loans, particularly if you have to use private loans, because the private loans are usually based upon prevailing rates. And so if prevailing rates stay where they're at, then you're not going to have to pay more with higher interest rates. So those are probably the big losers, the big winners. The undetermineds would be everybody else, because part of the message when the Federal Reserve says, hey, we're not going to raise interest rates, part of that message is that they have some concern about the strength of the underlying economy. I mean, let's call it what it is. So when the Federal Reserve basically raises rates, right, they are saying that we think the economy is strong enough to try and tap the brakes a little bit and raise the cost of borrowing. Correspondingly, they cut rates when they are concerned about the strength of the economy, almost like putting their foot on the gas, if you will. Well, if you take your foot off the gas and you're not quite putting it on the brake, you're kind of in that question mark zone, if you will, where the Federal Reserve is basically saying, well, we don't see anything dramatically bad, but out there economically, but neither do we see anything dramatically good that would have us tap the brakes a little bit. So that's kind of one of those zones where you're not really sure economically where things are headed. I mean, certainly the Federal Reserve is looking at the data and the data that makes the headlines that we all see, and those headlines are things like China and the Chinese economy, and to a certain extent the trade dispute, along with Brexit and what's going on over in Europe, and so those are factors, obviously, that could affect the global economic cycle, and it's that information that the Federal Reserve is looking at to determine, okay, what do we need to do with interest rates? So certainly something to keep in mind that anytime you have a story about the Federal Reserve, there's winners, losers, and everybody else. And the big question is on the everybody else category, because if you think of interest rates working like gas and brake on the economy right now, we don't know which direction they're going, because they've got the foot off the gas and the foot off the brake, and I guess we're coasting mode, which doesn't give you a clear sign of what exactly is happening economically. It is certainly not saying that the economy is booming. Otherwise, they would be continuing to raise rates, and thereby tapping the brakes a little bit, if you will, on that overall economic output. So some interesting news this past week, particularly with the Federal Reserve, and more specifically how it relates to you in terms of how that would play out for your future. Unfortunately, if you're saving money, it kind of keeps your rates relatively low. If you're borrowing money, particularly homeowners or home buyers, no reason to necessarily rush, if you will. I think because they're going to hold rates steady, that at the end of the day, you will not miss out on. It's not like the rates are going to go higher, and you're going to be paying more on your mortgage. You're probably going to be paying roughly the same amount of money. So some important things to think about when we think about what the Federal Reserve announced this past week. I ran out of time, so I'm going to have to kick this topic to next week. It was the topic about things to be aware of or red flags to avoid when doing your taxes in order to avoid an IRS audit. We'll kick that to next week. It'll still be timely next week because, after all, it will still be tax time and probably even closer to crunch time tax-wise as we get closer to April 15th. So we'll cover that next week. You missed any part of the show and want to hear it again, we will post it tomorrow on the various social media networks and also on our website at nelsonfinancialplanning.com. So thank you all for listening. We'll get on out of here. This has been Dollars and Cents with Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hettinger, and you've been listening to Dollars and Cents with Joel Garris of Nelson Financial Planning. If you missed any part of today's show or want to listen to it again, check out the radio show at www.nelsonfinancialplanning.com or connect with them on Facebook or Twitter. Be sure to call Joel this week at 407-629-6477 to schedule your free consultation to discuss your retirement plan.